A very good evening, everyone. Thank you for joining us today. Uh, Today, we have a very interesting speakers with us today. Basically, it's the representative from NetLink NBN Trust, the CEO, Mr. Tom Yu-Hing. Do you want to wave to the crowd? And of course, the CFO, Ms. Diane Chen. All right, just a brief introduction on the two speakers today. Mr. Tong has been the CEO of NetLink Trust since January 2016. Now, in this role, he is responsible for the overall leadership and performance of the trust. So basically, Mr. Tong brings with him more than 20 years of experience from senior management position in various industries. Prior to this, he was the Executive Vice President, Corporate and Market Development of Singapore Technologies Electronics Limited. Before that, he was the CEO of City Spring Infrastructure Trust. So, as someone that's very experienced, that will be sharing some of the ideas and strategies on how the trust company will move forward. So, if you have any questions, feel free to remember to stay until the end and participate in the Q&A session. And of course, Ms. Diane Chen is the CFO. She oversees the finance function, treasury and corporate finance compliance, enterprise risk management and sustainability, procurement and warehousing, and administrative matters of internal audit. Now, I like this. She is also the designated Chief Sustainability Officer. So, if you have any question regarding the sustainability initiatives that the company is doing, feel free to ask her as well. Now, today's topic will focus a lot on the earnings, which we have seen the revenue has gone up, EBITDA has gone up, DPU proposed is also increasing. But of course, the question is the profit of tax after tax did drop a little bit. So probably some of you might have some questions on that front. Now, if you're not very familiar with NetLink NBN Trust, it is actually formerly known as OpenNet. It owns, designs, builds, and operates the passive fiber network structure of Singapore's next generation nationwide broadband network. So that's a lot of if you've been following the in this era is all about network, then you will know that this is one of the companies that you want to be looking into. Now, I'm Billy Zhou. I'm the head of content and investment lead at Prosperous. Before I pass the time to our two speakers, just a brief background on some of our company and our promotions that we have. Now, Prosperous is basically the digital investment services by CGS CIMB that is created for digital natives like you and I. We provide you with the best-in-class service. What we mean by that is that we provide you in terms of educations, investment insights, as well as some of the experience through our rewards system. So feel free to follow us. Now, this is what we have for welcome offer for now. For those of you who want to join us, basically you'll be getting up to $88 with your new account deposit. So how are you going to get this? It's very simple. All you have to do is open an investment account with Prosperous and make an initial funding of 3,000 Sing and hold it for 60 days, and you actually get 38 cash credit. If you make an initial funding of 10,000 instead and hold it for a period of 60 days, you get $88 cash credit. You will also be enjoying a free 1 month RIKE subscription, which is worth about $20 when you open an account with us. There is also no minimum commissions on SGX trades with commissions as low as 0.06% for everyone. So perhaps this is the best time for you guys to sign up and start trading and investing, especially on the SGX market. If you look at us, you will actually find us on both the Google Play and Apple App Stores. Some of the things that we provide is not just the Singapore market. We also have a lot of different markets in whether you want to invest in Singapore, Malaysia, US. We also have various asset classes that you can invest into. So feel free to follow us on our social media, where we share a lot of our investment insights on a daily basis to our clients as well as to some of our followers as well. So without much further ado, I'm gonna pass the time to Tom. Over to you.
Thank you, Billy. Thank you very much. And firstly, a very good evening to every one of you, and thank you for spending time joining us on this webinar. I will start off with the presentation of our business, and my CFO will also join me in this presentation. So all in all, the presentation will take about 10 to 15 minutes. Thereafter, myself and my CFO will be happy to take any questions that you may have. Let me go straight into the presentation. On this page, I use this page to explain our business. NetLink NBN Trust is a fiber to the home operator in Singapore. So on this page, you will see quite a few numbers, right? Today, we have 1.491 million residential household using broadband through our fibers. And we have another 52,568 non-residential users also using broadband through our fibers. And then we have outdoor location, 2,823, what we call embed connections. These will be fiber to the lamppost, fiber serving Wi-Fi base station, Wi-Fi hotspot, mobile base station. And we also have another 3,218 segment connection. What are segment connection? These are from building to building, from central office to central office, and so forth. So this snapshot give you a good idea of the number of fiber connections we have island-wide today. What I have not mentioned is that central office. You will see one in the middle of this picture. We operate from 10 central offices across the island in Singapore. So with 10 central offices, we cover the whole of Singapore. So we are basically a fiber to the home fiber operator and nationwide fiber operator covering the whole of the Singapore island. Over to the next page. We get asked a number of questions about our fiber assets, about the useful life of the assets, also about competition, and also about the future prospect of this business. So we put together this slide to address some of these questions. We would say our business is future-proof. Today is the only means of fixed broadband delivery in Singapore. What do I mean by that? Many of you, or some of you may recall that in the past, broadband in Singapore, you could have a copper wire broadband through ADSL. You could also have broadband through cable TV broadband. And then you also have fiber broadband. So fiber was one of a few type of broadband services available. But today, and for a few years now, fiber is the only means. So if you want if you want broadband access from your home, if you sign up a package with any of the telcos, it will be using our fiber, NetLink fiber. So it's the only means of fixed broadband delivery today. And therefore, we have a very high residential penetration rate today. Fiber broadband prices are also lower in Singapore than in many other countries. This is helpful because it makes broadband internet more accessible to a wider population. Fiber is also increasingly being used for last mile wireless access, such as connecting to Wi-Fi hotspot, 4G, 5G base station. Fiber capacity is also highly scalable. What do I mean by that is that the same fiber could be used to transmit data of different capacity, different data rates. Today, most of us would have subscribed to a broadband access of about 1 gigabits per second. The same fiber could be used to carry up to 10 gigabits per second. That's not the issue. And going forward into the future, it could even carry higher data rates, 25 gigabits or 40 or even 100 gigabits in the future, well into the future. So it not only can support different transmission technology, different data speed, but fiber itself can last a long time because it's a passive piece of assets. Once we lay it in the underground ducts, we don't disturb it, it will last us a long time. So it has a very long design and useful life. Over to the next page. Okay, here's a quick look at our financials. We reported our half-year result on the 3rd of November, just recently. So you can see on this slide that the revenue has grown 2.9% to 205.3 million compared to a year ago. And EBITDA or operating cash flows has grown 2.4% to 149.1 million. And on the lower half of this slide, you will see a few key numbers. Net gearing, 21.5%. I would say this is a very comfortable level of debt. We could certainly borrow more if we need to. Weighted average debt maturity is 2.9 years, and the market capitalization based on the unit price of 84 cents is 3.3 billion. Over the next page. Oh, here's a quick look at the trend, the growth trend over the years. For residential connection, we have grown steadily, and we have reached 1.492 million at the end of September this year. Non-residential also has grown to 52,600, non-building address point to 2,823, segment fiber to 3,218. Next, please. This is a slide that we like to use to explain our business model. I would say our business model is a very resilient one. And these are all the revenue stream. You can see the different columns. These are the different revenue stream. We derive about 60% of our total revenue from residential connections. So the 1.5 million, approximately 1.5 million connections will generate about 60% of our total revenue. And if you know how people use broadband, you will understand that it's very stable, very low risk, because once home user get connected to broadband, they will stay connected. There's not that much of termination. And if it's termination, they will renew it with another operator. So we continue to get the connection and connection revenue. On the non-residential connection side, we get about 8% of our total revenue. And then embed and segment connections are the outdoor connections that I talk about, or building-to-building connection. We also get about 6.6% of our total revenue from Singtel because they lease our underground ducts. They use the duct space for their own fiber and copper connection. And then further to the right, you can see co-location revenue, 4.8%. This is the leasing of our space to other telcos because they would be housing equipment in our central office. And then you have central office revenue. This will be leasing of space to Singtel. So we derive 4.1% of our revenue through that arrangement. We also have installation related and other revenue, and also ancillary project revenue, 6.3% and 5.5%. These are more activity-based revenue, a little bit less predictable in a sense, but it's driven by the volume of construction activities. But over the years, our experience has been that there continue to be a steady level of construction activity year in, year out. As long as there's construction activity, we would have installation work to do and ancillary project work to do. I will give you a quick example of what is ancillary project revenue. It's actually diversion work that we carry out for LTA, HDB, or other agencies before work is carried out. If they want to construct a new underground pipe or a new MRT station, then they will require us to move our cable away, and they will have to contract us to do that. So we get a steady stream of revenue from that. So if you look at our model from the left to the right, a very stable sources of revenue, I would say. Over the next page. Here's a look at our focus. Being a fiber to the home operator in Singapore, obviously we are very focused on making sure that our network reach is comprehensive, right? Every corner of Singapore we would cover, every new building coming up we would connect, be it residential or non-residential, we will connect our fiber to those buildings. We are also looking to densify our network, basically putting more fibers into the ground because we anticipate that there will be more use of fibers going forward. So we also have enhanced our capability to support what I call fiber to anywhere deployment, meaning we anticipate that in the future, there will be more deployment of fiber to outdoor location, to location outside of building. So we call this the fiber to anywhere type deployment. We are also working to improve our fiber reach into enterprises and government segment. And I could talk a bit more about the third point later on. We are helping and supporting the Singapore government in the upgrade of the nationwide broadband network. Many of you would have read that the government has announced in March this year that they would like to upgrade the entire network, fiber network, to support 10 gigabits per second. Today, most users in Singapore are using broadband at 1 gigabits per second. So what we would like to do is to upgrade the entire network so that it could support 10 gigabits per second. So that every home user who wish to have a 10 gigabits per second link could have a 10 gigabits per second link. But I will say here that it does not involve a huge amount of investment on our part because the same fiber could be used, but it could involve some investment by other telcos that have to upgrade their equipment that are currently housed in our central office. So they will have to go through an upgrade cycle, moving from what we call GPON, the 1 gigabit per second equipment, to XGS-PON, the 10 gigabits per second equipment. The fourth bullet point here talk about our investment. We are looking at investing overseas, but I will say here that we will be very cautious. We want to look for telecom assets that will generate very stable cash flows, we are not in a hurry to make investments unless we can find attractive ones that can generate stable cash flows. We also have a program to create a better brand affinity with our end user, basically to raise the brand awareness of NetLink amongst end user. This we will do through multiple social media platforms. So this is something that's ongoing. With that, I will hand over to my CFO, Diane. She will take you through our key financials. Diane, please.
Thank you, Yu Heng. Hi, good evening, everyone. Thank you for being here with us this evening. I believe that you have seen our financial results for the first half, so I will keep it brief. I also see in the Q&A session, there are actually some questions, so perhaps along the way, I will just mention some of those questions that you may have already raised. So for the first half of FY24, our revenue is 205 million, and that's 2.9% higher than the previous half year. Mainly come from regulated asset-based revenue. As you know, when our connection number grows year on year, our revenue also grows. So majority of the growth of revenue coming from the RAP based on the connection number. EBITDA was 149 million, which is 2.4% higher than the previous half year. So similar trend as the revenue. As you know, our EBITDA margin is 72.6%, which is very close to the previous half year as well. I think since the IPO days, we have been able to maintain the EBITDA margin at above 70% level. So I think even though I think we do see some cost escalation in the first half of FY24, but I think we are still able to actually achieve a pretty consistent EBITDA margin. There's profit after tax is 1.7 million or 3.1% lower than the previous half year. And that mainly come from higher depreciation, as you can see from the slide, about 1.7 million higher. And net finance cost is also about 2.1 million higher than the previous half year. So also, income tax is also a bit higher in this first half. So all these three factors contribute to a lower profit after tax. Okay, the main depreciation, higher depreciation basically is a result of higher asset base as we continue to invest in our fiber assets. Okay, so but these are non-cash items. Higher finance cost is mainly driven by the higher interest rate environment at this point in time. Maybe I can bring you to the next slide. Yes, so you can see here, actually our gross debt, we have not increased our debt level for the first half. We are still at 735 million. And our effective interest rate is 2.64%, higher than 1.92% for the corresponding half year. So that is a reason for a higher interest cost in the P&L. But having said that, you look at the balance sheet ratios, almost 70%, says 69.4% of borrowings is already hedged at a fixed rate. So actually, that's why we are able to maintain a very relatively comfortable interest rate at this point in current interest environment. And you look at the other ratios, net debt to EBITDA interest cover, we are actually at a very good level as compared to other industry peers. So I think all in, I think here what I want to highlight to you is that we still maintain a very strong capital structure and a balance sheet to fund our future growth and capex. Then on the right side is actually cash flow, and you can see as well net cash from operating activities for the first half of FY24 reported at 154 million. Very strong, more than enough to cover. Together with cash is actually more than enough to cover distribution, and together with cash reserve, we also be able to actually comfortably fund our capex without drawing down any further debts. So this is the cash flow. Next slide, please. Yeah, I think the distribution, you will already know that we declared a distribution about 2.65 cents per unit for the first half of FY24, and this is 1.1% higher than the previous half year. and it represents about 6.3% distribution yield. And so I hope this is a good satisfactory outcome for you. And I think NetLink continues to grow our distribution per unit. If you noted that since IPO days, July 2017 till now, we had already returned in a total 1.2 billion to the unit holders without calling any equities. So that is our distribution. I think this is the last slide, right? Yeah, okay. I think I will stop here. Thank you. Then we shall take questions from you, Andy.
Thank you for the comprehensive and of course a very, very quick one for that share in terms of the performance of the company as well as on the strategies going forward. All right, we do have some of the questions in already, and I think Diane has also answered some of them. But I guess just wanted to know, in terms of we saw the slight decline in terms of the margin. Do we expect this to continue, or things are expected to improve going forward?
Okay, maybe I try then.
Sorry, I missed the first part. Which slide are you referring to? Sorry.
No, it's not. It's the question that came in. So basically, they're asking about the trend of the earnings, whether there's in terms of the margin, we've seen a bit of decline, I think. But do we expect that to continue, or do we expect an improvement going forward?
Okay. Thanks for that. Sorry. Thanks for that. And Diane, if you don't mind, I'll just start first, and then you could add on if necessary. I think if you have been following us, and a lot of investors have stayed with us for many years, I think you will see that our EBITDA margin, which is a number that we are very focused on, has stayed very stable. At IPO, I recall that we said that we historically have always been generating about a 70% EBITDA margin, which is quite a healthy level. And after IPO, our expectation is that to manage it at that level. And actually, since 2017 till now, we have always been slightly above that 70%. So going forward, obviously, we didn't give any kind of a profit forecast and things like that. But our expectation, looking at the cost and all that, and the revenue, we are still targeting to maintain at this level of EBITDA margin. From year to year, there might be slight variation, but I think on the whole, because our business is very stable, I just explained that we have a very resilient business model. The various revenue stream, firstly underpinned by 60% residential end users, and then another 8% or so by others, and so on. So we have a very stable cash flow, stable revenue stream. So we expect our margin to be quite stable going forward. Yeah.
Okay, and that's good to know. I think the second question I would like to ask, because I think I also wanted to know, because I'm also not so sure about this. Is there any competition in the space that you guys are operating in? I suppose that businesses in Singapore, I suppose there wouldn't be any monopoly. We are not too aware of this.
Officially, we are not a monopoly, right? But in our space, as a fiber to the home operator covering the entire island with our fiber network, we are the only one. So it will be very challenging financially as well as logistically for someone to replicate the network to cover all of the household in Singapore. Is near impossible to do. So in the residential space, I would say some people view us as a monopoly, right? Even though officially we are not, because it's very hard for somebody to replicate the network. It doesn't make sense to. So we have a very strong position in the residential space. In the non-residential space, it's actually different. In the non-residential space, any telco could lay cables, fiber cables, if they wish to any building, commercial building. And they do that too, right? There are a number of telcos that lay fibers to commercial building because they see that for the enterprise and for commercial businesses and offices, they could derive better revenue from it. And if they think that they could derive significant revenue from it, they will lay the fiber cable to those locations. So in this, what we call non-residential space, we actually compete with all these telcos that lay their own fibers to this non-residential space.
Okay. So in a way, for the residential space, it's just that the barrier of entry is very high. I'm
Yeah,
guessing.
very high.
Okay,
Very high.
okay, that's good to know. And I'm just wondering, I mean, I look at even your margin, although there's a slight decline in profit after tax, but overall it has been pretty stable, like you guys have mentioned. Could you share some of the initiatives that you guys have done to sort of maintain this, despite of the inflationary pressure and of course the rising interest rate environment as well?
Okay, I think like many companies in Singapore, currently we all face increasing costs and so forth. I think we do a number of things that are quite similar to what other people would do. Of course, we look for more competitive tender, longer term contract, or sometimes shorter term contract, so that we have the ability and flexibility to retender and find the best and most cost effective arrangement. So we do that. We also look at procurement of fibers. If the current contract is attractive compared to market prices, then we will buy more based on our current, because we have multi-year contract. If it's less, then we may want to wait for a while to call a new tender. So we do some of this procurement and contract management stuff, but by and large, actually our cost is part of the regulatory formula, and is a cost pass-through. Obviously, we have to convince the regulator that these costs are efficiently incurred. So I will also address this question as to why it has taken quite some time. We are supposed to have completed the regulatory price review, because every 5 years the regulator will look at all the capex, opex that we have spent and make a decision for the next 5 years, right? So it has taken longer, and we have not concluded it, but we expect it to be concluded before the end of this year, calendar year. I would say we have not concluded it also because in the last 6 to 9 months, the whole environment has changed. There's elevated interest rate, elevated inflation, operating costs have gone up. So we have had, I would say we have had more detailed and longer and more discussion with the regulator around all these numbers. So it has taken us more time, taken us, both of us, regulator as well as ourselves. What does it mean, right? I say this to address your question, how do we manage costs? So we want to convince the regulator that all of these costs are efficiently incurred, and they should be factored into the formula so that we can recover it going forward. So we will show them the latest contract that we enter into, the latest material costs and so forth. So, and also the latest staff costs. So all these are included in the discussion with the regulator. So that's our way of managing it. In a way, we are different from other businesses in Singapore because we are the only one with such a regulatory formula that allow us to recover operating costs. We have to have a discussion with the regulator. We have to give them a projection. We have to justify all those costs. And if they accept, then they would allow us to recover those costs. So this is a way for us to manage cost recovery. Yeah.
Oh, okay. I mean, since you talk about that, I'm just wondering, is there like a timeline that this sort of regulatory review must be completed? I mean, you say you expected it to complete by end of this year.
There is no fixed timeline, although the regulatory framework says that it will be every 5 years or anytime the regulator decide. So right now we have gone past the first 5 years, and according to the original timetable, it should have been concluded already. But there is really no fixed timeline. It can take longer if it's necessary for both parties to look at the numbers in greater details, which is the case now, right? So basically, both of us have spent more time to look at the numbers. But my expectation, why do I say we expect to conclude end of this year? Because we have done all the homework already. They have done all their homework. We think we are reaching the sort of a decision point soon.
Okay. Right. I mean, earlier you also talked about the upgrade of the network in Singapore, right? Could you elaborate on the capital expenditure plans that you guys have, especially in terms of the network expansion and upgrades?
Firstly, I would say it's early stage, so we don't have a definite number. And actually, internally, we also don't have a number yet. But we have some ideas of what is required. So therefore, just now during the presentation, I say I don't expect it to be a large sum of money, because the upgrade does not involve investing in the fiber network too much. The same fiber could be used. The fiber network is investment in fiber network. If we have to do that, it will cost a lot, right? If we have to replace the fiber, but that is not the case. We don't have to replace the fiber. The same fiber could be used. We will be investing in our central office to make more space available to increase the power supply to the racks, so that the new equipment, which are more power hungry or has a sort of higher power requirement, cooling requirement, we can serve all those requirements of the telco customers that bring in equipment that consume more power and therefore require more cooling. So basically, we're looking at space, power, and cooling. What can we do and to enhance those to support the new equipment that our telco customers will bring into the central office? So some amount of money will need to be spent. We have some idea. Don't get me wrong. We have some idea, because since we know that this is the path going forward, we have been looking at our facility, looking at the excess capacity that we currently have, what additional capacity we need to bring on board, and how much it will cost us, right? We may need to bring in new power equipment, new cooling equipment. So we have some ideas, but I would say at this point in time, we don't have a definite number, because the regulator is still in the process of engaging all the telco players to understand how soon they want to upgrade. So that decision has not been made because there are many players in the market. As an individual, you will know you can subscribe to telco A broadband, telco B broadband, telco C, D, E, F, right? So all of them have not provided their up-to-date rollout plan, I would say, to the regulator as yet. So when we see that, then we will know how soon we need to incur the cost. But at the end of the day, it is not a lot. From our perspective, not a lot. I think our investment in our fiber, the normal investment that we make every year in our fiber, will still be more than this investment in the upgrade to the space, to the room, to house all this equipment. So it's not going to be a lot, but it's actually a positive development, because if you understand our model, we are regulated under what we call an RAB framework, regulatory asset-based framework. What it means is that for every dollar that we invest, we will get a return on it. So this is an opportunity, this upgrade is an opportunity for us to invest, and we will invest so that the room is prepared for and able to accommodate all the new equipment. So this investment will increase our RAB, and therefore we will get a return on this investment.
Okay, it's good to know. But there's another question. I'm not sure if you can answer this if that's the case, because it's asking about how do you see the trend for both the capex and depreciation costs over the next 10 years?
I think difficult to do. I will always refer investors that ask us about capex and opex to our historical numbers, because our business is very stable, and year in, year out, we continue to invest in capex because there's a reason to do that. We continue to expand the network to reach out to new buildings and all that. So every year we will continue to do. So there's a steady number. So for a few years after IPO, initially after IPO, we spent quite a lot because we bought more assets from Singtel. But thereafter, we reached a steady level of about 70 or so million every year. This year and last year, last year we have spent more. That is because we spend more because we have some IT spending. We also have a new CO. We announced that, so it's public information. We are going to complete the building of the new CO. We are building it this year, next year. It's going to cost us up to $100 million. So we are spending more. So if you can look at the trend, my expectation is that going forward, the trend will be around this kind of number, and plus minus. And it's good for us because as long as we continue to invest in capex, all these capex will be rolled into or included in the RAB. So we will get a larger and larger revenue because our RAB asset base will increase with the capex invested. In terms of OPEX, I already mentioned that we target a 70% EBITDA margin, right? So yep. and we want that to be stable. We expect to be able to manage it. Of course, the environment could become more challenging, but we will be trying our best to make sure that we maintain a stable margin going forward. Diane, you want to add to this?
No, I think you have given quite comprehensive. Just that in this 2 years, we probably spend a bit more capex because of the new central office lah. But then after that, yeah, this will be the two FY23, 24, and perhaps it's a higher. But after that, it be like what Yu Heng say. It goes back to the historical. We're probably spending quite similar level to maintain the what I call it organic growth lah. Yeah.
Okay. And in terms of, I noticed just now the borrowing rate that you actually put on fixed rate is at around 70%, right? Is this something that you've been doing in the long, or you have always been doing it, or is it do you plan to increase the exposure in fixed rate borrowing, or what's the strategy?
Yeah, I think we of course we try to hedge because our cash flow is quite stable, our business is quite predictable, so we will try to hedge as much as possible our debts. But I think for last year to this year, for the last two since FY23, the interest rate has on the rising trend. So we actually haven't we have been closely monitoring the situation, but we haven't found a good window, a good rate to go into to hedge the remaining 30% exposure. So I mean, we'll continue looking at it. I mean, for from now till next, we don't have, okay. I mean, maybe I just want to add that we actually don't have a pressure on refinancing. None of our loans is coming up to due for refinancing in the next financial year. So I think we have actually quite a good we are in the right space, good space to actually look at the market movements and make a careful evaluation when we want to go into a next level of hedging. Yeah.
Okay. Just want to add on to this and talk about interest rate. I mean, I know that the pressure in terms of the inflationary pressure has come off a little bit. I mean, the US numbers has come down a bit, so there's a bit less pressure. But if the interest rate were to remain higher for longer, how will this affect the companies in terms of earnings? Will it be significant? No, right? I'm assuming.
I think as you can see, let's say for the first half of the year, we didn't actually draw down much of a loan. We didn't draw down loan at all, right? So actually that's because our cash flow still remains quite stable and strong to support our operation, the capex, as well as also the outflow, cash outflow. So I think with the 70% level hedge, if we draw down further loans to fund the capex, yes, this 69.4% would drop slightly. But I think based on the capex planning, we don't expect this to be dropped very fast. This level, we are not expecting to draw down a lot of debts in the near future, and causing this hedging level to drop significantly. So I guess at this point in time, we're still quite comfortable with this the current level of effective interest rate to continue. Yeah.
Okay. I think there's a question on the sustainability of the distribution of the company. I mean, I think 6% is attractive. And I think based on your track record, you've been increasing your DPU for quite a few years. So that's a positive sign. But could you share in terms of, is it at this level, is it sustainable?
I would say it is definitely sustainable based on our business. And if you look at at IPO, we said that we have highly predictable and stable cash flows. And indeed, I think over the last 6-7 years, we have continued to distribute. I think we are probably the only company that in this space that have not raised new equity. We only distribute, and the distribution has only gone up. We have never cut the distribution. Yeah. I think the question is also asking me, okay, so far so good, but what about going into the future, 5-10 years from now? The thing is this, I think if we want to look at sustainability, we have to look at the asset life and whether or not, firstly, asset life, secondly, whether you need to spend capex, so-called maintenance capex, to upkeep or to renew the assets. Our asset life is very long. Fiber and underground ducts and manhole, different number of years, but on a blended basis, I would say roughly 30 years. And they do not require maintenance capex to upkeep. So to make things simple, they will last 30 years, let's say roughly 30 years. Of course, we have spent a couple of years already, but it will continue to generate cash flow based from this asset. It will continue to generate cash flows. I do not need to raise money or spend capex to upgrade or to maintain this. So then you would ask me also, then what about the capex that I just talked about, right? The money that we spend, the 70 million or the $100 million that we spend, those are what I call growth capex. They are used to expand our network, and we earn a higher return, right? I think compare ourselves to others when they actually raise money for growth capex. We don't, right? We don't. So we have retained our cash flows for this capex, part of the cash flow. So we did not distribute all of our cash flow every year. So we retain part of it to fund the capex. We also borrow some amount to fund the capex because our borrowing level is our gearing is still below the net debt 2 times, right? Still very low, right? At IPO, I think we did say that we will want to make sure that our net debt to EBITDA will remain in the investment grade region, right? And for a company like us, a net debt of 2 is definitely in a strong investment grade position. And we have a lot of ample room to raise more debt to fund future capex and future growth. Yeah, so I would say cash flow is going to be stable and predictable.
Okay, that's good to know. I think someone mentioned that you guys are commendable for being a reliable and steady sort of earnings and of course distribution back to shareholders. I think, but the question is, given the at the backdrop of high growth in the tech sector, how about growth? Is there any plans to boost your growth to attract shareholders in? Like, I think this is interesting, right? I mean, you guys have been very relatively stable, but so there's probably room for you to sort of take a bit of risk and expand and sort of generate that sort of growth.
I think it comes as a package. Risk return comes as a package, as we know. So no, but as management, I get asked a lot. Certainly, we want to look at growth. But our business in Singapore, if we stick to our business in Singapore, the growth will continue to come from new housing, because every year there will be 25,000 new housing units roughly, and growth in connection to the outdoor location and all that. But relative to where we are today, because we have reached quite a high level of connection today, the growth will be quite low single-digit growth. So if we just stay at this kind of trend, then our growth will be at a fairly low single-digit growth. That's a fact, right?
Yeah.
Well, what could change this, right? We are trying to look into, can we provide more fibers to the outdoor location? Would users, government agencies and others adopt the latest application technology earlier so that they will require even more fiber to the outdoor location, generating more fiber connection growth for us? We are always looking into this, and we are also looking into how we can help them, right? Actually, we just released a new plan. I could say that here because we just announced the plan. There's this quantum safe network. I don't want to talk too much about the technology because really I also don't know a whole lot about the technology. But we have filed a new tariff plan. That means any operators, any telco operators or enterprises that wish to try out and roll out a quantum safe network, we will offer our fibers with very little cost or no cost to encourage them to try it out. We have been in partnership with with the University NUS for some time, offering them the fiber to test this quantum safe network, and they have tested it successfully. It's in the media anyway. You can look at that. We have also partnered with other telcos to provide them the fiber for them to test it. But in the future, there may be more demand for quantum safe network, which will then drive up fiber connections. But it probably a bit too early to say, right? I don't know how the technology will evolve and how rapid the adoption would be. I'm just highlighting this as an example of us trying to be proactive to look at how we can accelerate or support others who are trying out new technologies. So organic growth, apart from all these new applications, may be more limited, as I mentioned. But if we look at the positive side of this business, then it has very low risk, right? So I guess it is a low risk, stable yield entity. If you want to add on higher growth outside of Singapore, then we will have to look at investments. But I will say this, we are not about to go into higher growth investments, higher risk investment. We like to keep this to the current low risk profile. But don't get me wrong, we are also interested in growth. So my first priority is trying to find growth in Singapore itself because it's lower risk definitely. But we are not giving up the idea of investing outside Singapore. We want to. We have looked at actually many deals, many transactions. But we want to be very careful because I will give you maybe an example. A greenfield fiber network in some sort of a developing country naturally will have very high risk because it'll take a long time to roll out. You will spend capex every year. It's probably not something that will fit our risk profile, right? And then on the other hand, a matured data center or series of data center in a developed country today, I'm sure you know, it's very expensive.
Yeah.
A lot of people are buying up all these data centers. It's a growth area, no doubt, but still, at the end of the day, getting into a growth area depends on also getting in at the right valuation. If the valuation is very high, then it's very difficult to make back all the money that you have invested in. So we are not about to do that. So we want to make sure that we do the right thing for investors, continue to focus on our local business, generate a steady yield, but at the same time, look out for opportunity to expand our network in Singapore.
So the focus will mainly still be in Singapore, right?
Yes, mainly in Singapore because it has to be because this generate us the strong cash flow that we are enjoying today.
Okay. I think there's a question on the Iskandar Free Trade Zone. Does that offer any opportunities for you guys?
No, I'm not familiar with that, I must say. I have not looked at it. So, but it may mean more data centers because data centers are now being located north of Singapore and more connection to Singapore. That could drive up more demand in Singapore for data center to data center interconnections. We only do fiber connection in Singapore, but anything that come into Singapore, more data coming into Singapore actually will always help because the data center in Singapore will also need more data center to data center interconnection.
Okay. Okay, I think enough. I mean, we've got quite a lot of the operation side of things. I just want to ask a bit on the sustainability initiative since we have the sustainability person here. So, Diane, probably for you. So, could you share some of the initiatives that are being run by the company that you want to highlight so that investors who are more keen to invest in companies that are focused on sustainability could also be aware of some of these initiatives?
Okay, thanks for the question. I think first of all, I think our business actually don't generate a lot of carbon emission and don't use a lot of energy. So I think because I think fiber is actually passive, so it doesn't actually consume energy. So I think for what we have, that's why you see, if you look at our sustainability report that we put up in the annual report, our scope 1 and scope 2 energy carbon emission is actually very minimum. The bulk of the carbon emission comes from scope 3. And scope 3, I think it requires a lot more effort through collaboration with your vendors, with customers to come with a collective effort to actually bring it down. And it's actually a longer journey, which we are working on it. So that's one point to make because we need to actually talk to the vendors, we need to talk to customers to look at what are the ways that we could together reduce the impact of carbon emission. And I think in terms of ourselves, from our own business perspective, to reduce the scope 1 and scope 2 emission, we actually set ourselves a target to reduce 50% by 2030 and then the net zero by 2050. So align with the government's target. And to do that, what we can do is that basically our energy and carbon emission comes from our vehicle, our vehicle that runs around Singapore to service, to provide our services, and also cooling and energy, our equipment, we provide equipment and cooling a facility to actually for in a central office. And all of this, we actually, what we could look at is that we're looking at use a more energy efficient refrigerant to actually reduce the carbon emission that's in our central office. And when our vehicles actually due for, we are also looking at replacing our vehicles to electric vehicles when progressively, so that we reduce the consumption of diesel. And the other one is also we have been doing is to replace our lights. All the lights in the central office, we are replacing them with LEDs or sensor motion sensor kind of lighting system, so that all these small steps, small steps compared to other organizations that have a bigger impact, I would say. But these are the steps we have taken cautiously and with planned steps to get to a reduction. So I think I miss anything. Maybe I think the chillers. I think what I may not have mentioned, the chillers. We are also looking at replacing our chillers to more energy efficient. So all of these are what we are doing for the moment.
And just wondering, I think it's a bit contradiction to my questions, because I asked about sustainability, right? And you talk about the initiatives, but will this result in replacing EV and with a more energy efficient some of these chillers? Will this result in higher costs, or just wondering? So that's why I say it's a bit contradictory, right? You want to talk about sustainability, but then I'm also worried about the cost. So is that something that's manageable?
Maybe I can chime in.
Yeah.
Obviously we all have to look at cost. And actually our chillers are not very new. They are old. So it's a question of, and it's also about time for us to renew most of our chillers. So it's quite timely. You see, I think nobody wants to throw out some new, even at home, right? It's a new light, you don't want to throw it out just because you want to replace with a LED light, Actually, it's not sustainable. Then you are buying more. Of course, your energy consumption will be lowered, but it's actually not sustainable to buy more. So we have to weigh that. But fortunately for us, many of our chillers are old in our central office. Our central office are not new building, right? So we will replace our chiller over the next few years. So there's already a plan to do that. So we take the opportunity to find the most energy efficient that meet our need. We also find those that have, as Diane mentioned, refrigerant that meet the test, meet the requirement of the sustainability requirement, more environmentally friendly type refrigerant. Yeah.
Okay, I'm gonna let you guys go soon. I just want to end with the last question. We talk a lot on the positive side. Let's talk a bit on the risks and the challenges. Could you share some of the biggest risks that the company has? I'm assuming it would be regulatory, but it's probably you can tell us.
Actually, we obviously we have operation risks as well, and this is something we are very focused on. We want to make sure that there's no disruption, but from time to time there will be some disruption. Sometimes it's IT, sometimes it's cable card and things like that, and you get to read about it sometimes, right? We as a team, we try to make sure that we minimize any disruption, and a lot of time the disruption is not caused by us. It's caused by other contractors doing construction work, cutting out cables and all that. So those are the kind of risks that we face. But you are right, also you mentioned regulatory risks. If you look at our entire business model, because it's a RAP-based model, regulatory asset-based model, the regulator every 5 years or so will decide on the return. So regulatory risk has to be the highest risk, because that one decision on the rate of return will change, will move the needle, so to speak, and will change the level of revenue that we can get and so forth. So regulatory risk is the biggest risk. But you don't get me wrong. I think in Singapore, the regulator understand that they need to also motivate the operator as well, right? So it's a balance between consumer interest as well. Balance the long-term interest of the consumer. What is in the long-term interest of the consumer is to make sure that the infrastructure is well maintained, reliable, and the operator continue to invest a significant amount to upgrade, to maintain, and to operate the thing. So since the operator as well as the regulator is focused on the long-term interest of the consumer, we should always get a reasonable balance. The rate of return must be good enough for us so that we want to continue to invest. If it's so low, nobody want to invest, So then it defeats the purpose. We want a very good network in Singapore. So I think the regulatory risk, although I say, if you ask me for single biggest risk, it has to be regulatory risk. But then on the other hand, if you look at all these other factors, it is manageable. I would say it's manageable for us. And we don't see any indication that it will not be manageable.
Okay. All right. Thank you, Mr. Tong. Thank you, Diane, for your time. All right. For those of you interested to invest in NetLink NBN Trust, the company has a very resilient business model, as you can see from the increase in terms of the revenue and EBITDA as well as the DPU over the years. Net gearing is comfortable at 21.5% level, which gives them a lot of debt headroom. And of course, if you're looking for something that has very little downside risk except for the regulatory risk that we talked about just now, which of course, Singapore political stability is one of the strengths. You probably want to consider to invest in NetLink NBN Trust and take advantage of our current promo and sign up and get the low commission rate as well. All right. Thank you, everyone, for joining us. Thank you, guys. Bye.
Thank you, Billy, and thank you everyone for joining us. Thank you.
Thank you.